Thank you, everybody, for coming. We're so glad you're here. Today, we're really excited to have Jose Padilla talking about Series C term sheets. Jose has been an attorney for 21 years, started in 2000, and he's also a businessman. He has a lot of different businesses that he's involved with. He's very creative and very good at taking a process that should be relatively simple and making it kind of a set price package deal, dealing with attorneys. So today it's understanding term sheets, Series C. Thank you very much.
Thank you. I'm happy to be here. I really appreciate you guys taking your time out to talk about something that, would bore most people. And, my goal here is, well, I don't know if I can make it not boring, but at least I can try to make it understandable. And so about myself, as you mentioned, I'm an attorney. I went to Harvard undergrad, Penn for law school. I've started my career working for a private equity venture capital focused law firm out of Silicon Valley. And then I moved and worked in Washington, D.C. for a New York-based law firm. And a little known fact is that in the venture capital legal world, much like in hip hop, there is a rivalry between East Coast and West Coast. And so the documents and the style of lawyering is different. And I was lucky enough to learn both styles. And I try to do a mix based on kind of what's best for the client. But I've lived kind of all over the country, and I did spend time here in Nevada and loved it. And now I'm currently in San Antonio, Texas, where it's still too hot. I love the weather, here in Reno right now. It's great. And I also teach health law at NYU. And previously, when I was in Vegas, I taught gaming law at UNLV's Boyd School of Law. So I try to learn a lot of different areas, and but my main focus is really helping entrepreneurs. And in this area of venture capital, one important point I want everyone to kind of know is that the whole history of the legal documentation when it comes to investment is a history of trying to pay lawyers less money. So that's really kind of what we have to understand. When I started, the seed round was a Series A. Series A was kind of the initial investment you would get after like friends and family. And then, and the cost back then, I remember it would often be like $40,000. So people were trying to figure out how do we make this cheaper? So they came up with NVCA came out with model documents. And model documents helped, okay, now we have something that people can start off from, and it'll be less expensive. But it still is, like $20,000. So people are like, okay, how can we get this even less expensive? So people started using convertible notes a lot. So convertible notes was a way to get investment quicker and less cost to an attorney. And then they came up with Series C rounds. And that was a way to make things less expensive. And I think that we all know about Y Combinator safe notes. It's kind of the ultimate way. Hey, with safe notes, a lot of times you don't even need a lawyer at all. So there's been this whole history of it. And the thing to remember is, so a lot of the things in the industry, everyone needs to be a Delaware corporation. Everyone's using, standardized documents. That's all the goal of, well, the most expensive part of starting a company should not be your legal expenses. And that's been the goal. And that's part of the reason why I decided to start my own law firm about 2.5 years ago, as I was working as a general counsel hiring attorneys. And I just felt like, well, here's an industry where things are made to be cookie cutter, but a lot of the times people charge you as if it's, custom made. And or some make you feel like it's something mystical and difficult to understand. And so what I'm here to hopefully do is, when it comes to the Series C term sheet, to kind of help demystify some of that aspect, because it's intended to be cookie cutter. It's intended to be something that is kind of, made to be the same. And so you should be able to understand it, and it shouldn't cost you an arm and a leg. And one of the examples, kind of what she mentioned, the package deals I have. So it's an example of what I do is when it comes to Delaware incorporation, I have a package deal, $500 to incorporate a company in Delaware. That does include the Delaware fees, but it includes all the legal work to set up a company, do the filings, and also all the paperwork after that to issue the stock and basically make a company, a new startup, to be venture ready, essentially. And I thought that, it doesn't need to be thousands of dollars. It's something that can be done more efficiently. So with that said, what I'm using today is we'll be going through the SeriesSeed.com template. SeriesSeed.com is kind of like where MVCA has their model documents. A lot of lawyers use SeriesSeed.com for the template Series Seed documents. Some law firms have their own form, but this is the one that I've come across most commonly. So we're going to go over their template term sheet. And I think the easiest way is we're just going to go line by line on this, and we will start off with the intro paragraph. And the thing to remember about this part is when it's a term sheet, the word term sheet actually has legal significance. It's the same, actually, if it's a term sheet, letter of intent, memorandum of understanding, all of those signify from a legal basis that this is not enforceable. That's one thing to remember. It's not by using the term sheet, what this means, it's essentially a written handshake. So you're not necessarily bound by it unless inside the term sheet or letter of intent, it states that it or part of it will be binding. And in this case, you'll see that it states there at the last sentence that, last two sentences, that there's going to be a section called binding terms, and that's the only thing in this term sheet that's going to be binding. And then the last sentence is about that, well, the binding obligations are going to be in the definitive documents that come after the term sheet. So the whole point of this term sheet is let's kind of have a handshake. These are the general things that we agree on, the major terms we agree on, and that gives us confidence to then go forward with spending the additional dollars to have an attorney draft the actual documents that put these terms into effect. So that's one thing to remember. Your company would be here, which should be often be a Delaware corporation, and sometimes you'll have it mention the name of the lead investor in here. In this template, it doesn't need to be there, so the template doesn't have that. The offering terms, this is really kind of the meat of the term sheet. So it's the securities are going to be issued. Here it's Series C preferred stock. One thing to understand is the way it works legally with stock is you have different classes, and you have to treat everyone in the same class the same. So that's why you have a separate class for investors, which common stock will be for the founders, and for investors they'll want to be treated differently. And that's kind of the point of these terms is here's the ways that we're going to be treated differently than a common stockholder. And originally the preferred stock was created as kind of this hybrid between debt and equity, in that normally debt gets paid first if there's like a bankruptcy. And so preferred stock is designed to be paid before the common stock. So in that way, it's kind of this hybrid where you'll have your debt, preferred stock, and then common stock. If everyone was common stock, you would not be able to treat the investor differently. You have to treat all the common stockholders the same. So you create this new class of shares called preferred stock, or in this case, would be Series C preferred, and they'll be treated differently. And that's why when you have the next round, like a Series A investment with different terms, so then they'll be treated differently than the Series C preferred. And then Series B, C, and D, and so on. Those are different classes are designed so that everyone within that class is treated the same, but they can be treated differently than those in other classes. So that's one thing to remember. Aggregate proceeds, this is the amount of money that's coming in. Now, what's important here is this can be, you need to make sure it's going to be how much is cash actually you're coming into your bank account versus conversions of like safes or notes. Because a conversion of a safe or note would be considered kind of, you would put that dollar amount that would be included there. If you have like $100,000 safe note, it would convert this qualifies as a qualified financing under those terms, assuming that it would convert. And so you kind of add that 100,000 that then converts into the Series Seed. So then if you're saying that someone's putting in 900,000, well, the total amount is 1 million, but actual cash that's coming into your bank account, 900,000. So that's one thing important to delineate in this section if you were to have any safes or notes that convert here. Purchasers, the important point here is that it says, it's accredited investors approved by the company. Some investors, if you have a lead investor, they will also want to have rights to approve the other investors that are coming in. As a founder, you may want to push back on that. You may have people who believed in you in the beginning, gave you money, for example, in the safe notes or convertible notes, and that you want them to have the ability to buy into this round as well, in addition to the conversion of the safe notes. And so you want to be able to state that, these people, people that you want to be in this round, that they get to be in this round. But it is something that's often negotiated as to, well, who decides who gets to be in the round. Then the price per share, this is critical. And this right here could be the subject of another hour of discussion. So I'm not going to belabor it, but the point here is the price per share is essentially it's the valuation of your company. So, and it's going to be, and here it states it's based on a pre-money valuation of blank amount. So you negotiate that. That's one thing to remember. It's something that you negotiate. What I like to tell my clients is, and basically to keep things real, is a lot of times you'll hear different methods of calculating valuation. What I would say is the reality is that people want a percent of your company. And this is a way to negotiate how much percent of the company I'm getting. So these methods of calculation, whether it's based on comparables or it's based on revenue, these are really justifications. Because if I'm a professional investor, I need to have a certain percent of your company. But if I'm going to negotiate with you, if I'm negotiating, I'm telling you, I want to have 15% of your company. And you're saying, no, I'm only going to give you 10%. That's a bare knuckle brawl. That's very inelegant. It's kind of no win. It's really a tough fight. When at the end of this, you're supposed to be friends, or you're supposed to be aligned. Your interests are supposed to be aligned after this. So what I see is this is kind of an elegant solution to do that same discussion, because then you're discussing about, well, if I'm putting in $1 million at a 10 million valuation, that's 10% of the company, as opposed to, well, no, I'm saying it's a 5 million valuation, so I'm getting 20% of the company. That becomes a more elegant way to discuss whether I'm getting 10% or 20% of your company. So investors will know that. Investors will think like that. I think I'll find a lot of founders, they're trapped in this, well, here's this methodology for the valuation, it should be this based on this. And I'm like, well, that's a justification. What you really should be concerned about is the percent that you're giving up and the percent that calculates to, because the investor's thinking that. So you should think in those terms as well. But then the way you argue it is through justifying the valuation, what it is. So that's one important point here. The available option pool, that actually can change how much percent is being given up. So while the rest of this, I'm going through like the actual term sheet, this next slide, I wanted to just really focus on this price per share part, because it is really the most critical part of the term sheet. And so the basic calculation of price per share, and this is really for any company, whether it's a public company, private company, it's simple. It's really the valuation of the company divided by the number of shares. To put it in terms for a startup, it's the pre-money valuation divided by the pre-money capitalization. And then the important thing as an attorney, we're thinking, well, how do you define capitalization? That's essentially the number of shares. But there's the concept of fully diluted shares. So that concept is like, well, there's the shares that you've already issued, like you, your founder, you have these number of shares issued to you. But you may also have, or probably also have, an option pool. You already set up, well, I'm going to give X amount of percent of shares set aside for employees. And then the question is, well, if they've been set aside and you haven't given out any options, should they be included? Or let's say you have given out options, but they're not exercised. And if they don't vest and if they never vest or they never get exercised, well, then they're never actually on your cap table. So, the only people that in the sale of the company, the only people that will get money from the sale will be people who have shares. Now, a lot of options will automatically convert, but what that means is it converts and it becomes shares. So it's the number of shareholders that really those are the shareholders who get the actual cash in a sale. So that's kind of that important concept. But then there's the other concept. Well, an investor, they're thinking, well, there's this possibility of people that would convert or you would be giving out shares to. So then the question is, kind of coming back to the calculation is, well, what's that number? What's that number capitalization? So I put this example here, and the definition of fully diluted can vary. Fully diluted definitely always includes options that you've issued. So options that are out there that you've given to employees, that's always included in the definition of fully diluted. But the question is, do you include those, if you have an option plan to give 1 million shares, but you've only given out 500,000, do you include the other 500 that have not been issued? But you're expecting to. Do you include that or not? And the thing is, if you do or not, I mean, that affects the calculation. That's kind of what I wanted to show with this table here. So if there's a $5 million pre-money valuation, and let's say there's 5 million shares that the founders have, but their option pool is 1 million unissued. Let's say it's 5 million, and the 5 million is basically the founders and any issued options. And then there's a 1 million of unissued options. So if you do not include the unissued options, it's 5 million shares. That gives you a price per share of $1. And if you have $1 billion investment, that gives you 1 million shares. That's 16.67% of the company. If you include the unissued, you see then I have 6 million shares. That's in the capitalization, which means that it's 83 cents per share. And that means a $1 million investment gets you 1.2 million shares. And that's 19.42%. One thing important to know is when you're calculating this percent, when I calculate this percentage, that percentage is based on the number of shares that are out there. So if you were actually to divide the 1.2 million by, usually you do it 1.2 million divided by 6 million, that's including the unissued shares. But actually, when you're calculating how much percent that you own, usually you're calculating how much is owned right now. Well, unissued is not there right now. It's just a potential. So this percentage is basically, it's 90% of those that exist right now. So if you actually include the unissued in the percentage, the calculation actually comes out to 16.70%. So it's pretty similar. But the important thing to remember is what's there now versus what's potentially out there. And that's the rub there when you get into this discussion of what's included in fully diluted or not. And that will affect the amount that you're giving up to an investor significantly. So that's kind of what I want to stress here. And I guess you can kind of see why we can kind of talk about this for hours. It's a major point.
Can you go that way a little bit?
Yeah.
And I was trying to copy this down. 19.42% is what I needed.
And so next, an important point, after you get through like the valuation, which is obviously the biggest part of the negotiation in a term sheet, then there's liquidation preference. Liquidation preference is one of the singular rights of preferred stock, which is upon a liquidation event, which could be bankruptcy, sale of a company, any kind of event where you're kind of selling off the shares, merger is included that. Then who gets paid? Well, the preferred stock wants to get paid first, and that's their preference upon a liquidation event. Normally what you see is what's called a 1x liquidation preference, which means that if you sell a company, they were to get their original purchase price back. But it's a choice. That or they get what they would get if they were to convert all their shares to common stock. The way to imagine that is if you were to put $1 million investment and let's say the company was going to be bought for $2 million, but they only bought 10% of the company. Well, 10% of $2 million is 200,000. So then they're going to say, no, I'm going to exercise my liquidation preference, which is to get $1 million back. And then the other $1 million is then shared among the rest of the common stockholders. But if you're about to sell the company for $100 million, well, they are not going to exercise liquidation preference because that's only getting $1 million back. Instead, they're going to want to convert their shares to the 10% and get 10% of 100 million, which would be the $10 million. So it's that choice that they get. And that's what it means when it says liquidation preference. But and what I just described is called a non-participating liquidation preference. If you hear participating preferred, what that refers to is then they get both. They get the $1 million and then the rest, let's say it's $100 million, they get the $1 million and then the 99 million is split among everybody and they get their 10% of 99 million. As opposed to, or in the other example, or if, let's say the sales only for 2 million, they get their $1 million and then they get 10% of the million left over. So that's participating preferred. If you're a founder of a company, you don't want participating preferred. And thankfully right now, that is not as common. I have not seen that in a while. And then usually it's 1x. Sometimes you'll see 2x, 3x, which means the amount that they get back is not just the money they invested, it'll be 2 times the money they invested or 3 times. Again, I have not seen that in a while, but let's say the market becomes more difficult to raise money, you would, that is one of those things that does tend to creep in when people are more desperate for investors. You'll see different liquidation preferences. Conversion, this is basically the right of the preferred stock to convert to common. And that is, again, for those purposes like a sale of a company, they want to be able to have that right to convert. Or it's just the general kind of right. That's the kind of the point of it is the preferred stock can have the same rights of a common stock if they want, if they choose to convert it. And actually, this right is also used when it comes to AntiDilution provisions, which is not in the standard Series Seed preferred terms, but I've seen them sometimes put them in there. AntiDilution is common in Series A, but I see them creeping into Series Seed deals now. And they use the conversion mechanism as a way to do that. Next is voting rights. This is also called, you'll see this also called protective provisions. So if you see protective provisions, this is what it's talking about. This term sheet uses voting rights. I've seen other term sheets when they're talking about voting rights, they're talking about different things. In this case, these are provisions that are there to protect. It's voting. These are actions that require the preferred stock to approve before you can take these actions. So in other words, it's a way to kind of protect the preferred stockholders. So this list is pretty standard list of things that would adversely affect the preferred stock. Sale of the company, changing the number of authorized shares, things that would kind of mess with their rights. Well, you need to have their approval to change those things. And that makes sense. But the important thing is I've seen some investors, they'll add things to this. It could be not being able to take on debt of more than $50,000, or it could be other things that affect your ability to run your company. Things that, they just want the ability to approve your ability to do something. You're changing your line of business, which means that you can't pivot the company without approval of preferred stockholders. Those are things that are a lot of times I'll see added, and those are things you need to watch out for, and you should negotiate because as a founder, you will want to have freedom of action. These are things that will limit your freedom of action. On the standard set of term sheet, the standard list, this is nothing here is really that controversial. I think it's really controversial, but there can be changes to this. This next section, documentation, this basically simply states that you're going to use the Series C. This can be important is there are some law firms, and especially some big law firms, so they just have their own set of standard documents. And if you don't have this in there, they'll just use theirs. For me as an attorney, sometimes it just kind of gets my nerves because, well, we all know these templates. And when I see these firm templates, it's usually the same thing. They're just in different order. So what that means for me is I need to now review this much more carefully because they could, change a couple words that have different meanings. And so I have to now read this line by line, and which means I spend more time, which means that my client has higher legal costs. Well, why not just use the same template where we know what things look like? I can do a red line easily to see if someone's trying to be funny and trying to change the templates. It makes things cleaner, easier, and ultimately less expensive for the founder. So that's why you would have this language in the term sheet to say, hey, we're all agreeing to use these template forms. Financial information. So this is a right that can be given to major investors. So if you have a lead investor, or maybe out of the investors, there's a couple of them that they're investing significantly more than others. They will often request this right to have additional information. This standard information and inspection rights, this is usually financial information. So it'll usually be it'll be the requirement will be that, you know, you send them monthly financials, quarterly and annual, maybe an annual budget plan. Now, again, these things can be negotiated. Often this is negotiated when you get to the next step. When you're going into the documents, you usually negotiate the details of it, because sometimes they may want audited financials and you don't want to pay for audit. So you'll want to make sure it's unaudited. I think the standard set of documents show unaudited, but you know, things can change. But that's usually this right here. The important thing to remember, because it's a dollar amount that makes it a threshold to be a major purchaser that gets these rights. Is for you, for a founder, the more people you have to have these rights, it's just more of a pain. So more of a pain to people that you have that are looking at your financials, have the ability to inspect your facility, someone you have to deal with, someone has more questions. You want to focus your time on building your business. So you want to limit this really to really the bigger investors. Yeah.
Are those sometimes called advisor shares?
No, this would be separate. This would be in the documents of the financing. They'll define yours as a major purchaser. Also, what you will have is sometimes apart from this, some investors will they'll just negotiate a separate side letter to have similar rights as here. So even if you have this threshold for major purchaser, there may be some investor for whatever reason, maybe because they are an advisor or maybe they had one when they asked for a side letter when they got their safe note and they want to continue having it, the request to continue to have this information. But the important thing to remember is how many people do you want to pinging you on a regular basis to give these financials? And if you're fine with, you know, having a set list, if you have a system in place, you know, 1 or 2 investors versus 10, you know, that's really the question here. The next is participation right. So the SeriesC.com template calls it participation right. You will also see this called as Prorata right. You also see it called preemptive right. A lot of different names. What it is, it's the right to purchase the same amount of percent that they purchased in this round in the next round. That is not really a bad thing for a founder, because what an investor wants is, hey, if you're doing great, they want to make sure that they continue to invest in you. The only issue for that could be is that if they don't exercise their pro rata right, that's a signal to the next investor. And that can actually create issues for you if they're not. But this is pretty much standard. A lot of preferred stockholders, they're going to require this. But to know what is it that you're giving up, well, it's the ability in the next round to for them to have their same percent. And the thing is, if you have some new investors, sometimes you have new investors who will be like, well, you know what, you're doing great, but I need to have X percent of your company. And I can't have that percent of your company if all these current investors exercise their pro rata rights. So that's when you get to this this conflict, which is why it's always important to kind of manage your cap table, to kind of realize there is, with investors, with venture capitalists, they have certain percentage that the targets that they have, because they have promises that they made to their limited partners. And so in order to meet those promises, they usually, they have their models, their financial models that show, okay, I need to have this percent of the company, and I have to have this company to, make this at least this amount of an exit, then I can meet these goals for my limited partners. So when it comes to the percent of ownership, they need to get that. So that's the thing to remember is to, okay, well, you don't want everyone to have pro rata rights. So that's the other thing to mention. This goes to the major purchasers. And that's why you need to make sure that the previous part, well, that definition of major purchaser, that's limited. And then also people will ask for side letters to get this right. You just need to make sure and look at your cap table. Okay, you're not filling it up, and it's if everybody has the same pro rata rights, and then not everyone exercises it, well, then you have issues, because then people are going to be wondering why isn't everyone exercising this? On top of the issue of, well, now it's hard to get new investors because they want to get a certain percent. So all these kind of issues are all kind of interrelated. The next section, board of directors, this is pretty much straightforward. This is the template language. Normally what you see, like prior to preferred stock round, or, you know, when you're first starting off the company, it's usually the board of directors, the founders or founder. It could be one director, two. Normally you see an odd number just because it makes it easier for voting. So usually you'll see 3 or 5. More than 5, it gets kind of unwieldy, especially when you're a small private company. So I usually see it's 3 or 5. And then it's usually in Series Seed, I see usually it's 2 out of the 3 are founders or founder designated, and then 1 will be the investor. With the Series Seed, previously, they would not expect a board director seat. It would be board observer. So they don't have any voting rights, but they would be able to attend board meetings. But I'm seeing increasingly more and more often that in the Series Seed round, they're wanting board director seat. But that is something that you can negotiate. You can push back and say, you know what, you're just giving board observer seat. A lot of it depends on how much money they're giving. Usually it's 1 at this stage for Series Seed. It's the investors get the preferred stockholders all get to choose 1. It's usually someone that's chosen by the major purchasers, and then 2 are founder related. Expenses. So a lot of times investors will ask for the company to reimburse the investors for their legal fees. The amount in this template is $10,000. That for me is a general amount. I mean, there's different arguments. There's some that say, hey, that's not founder friendly at all. And you need to push back on that. And the investor should pay for their own counsel. Because there are firms out there that whatever this number is, it's 10,000, it's 20,000, it's 5,000. Magically, their bill is always, $9,999. So whatever that amount is, just expect that's what it's going to be. So, but I would say for Series Seed, I did one recently where everyone was motivated, highly motivated to not spend money on lawyers. And so there was very little back and forth. They kind of agreed everything in the term sheet and they just didn't veer from the term sheet at all. And they let me know that they really wanted, well, part of it was the investment was very small. It was a very small investment. Traditionally for Series Seed, you wouldn't see one for less than 500,000. Normally it's more like $1 million, 1 million, 2 million. Then again, I've seen some for 5 million too. It really depends on the market. It depends on a lot of things. In San Francisco, you can see them for more for 5 million. In Texas, I've seen them for closer to 1 million. This deal was actually under 500,000. So they didn't want to spend money on lawyers. We didn't have much back and forth. My total bill was under 3,000. But if there is a lot of back and forth, if you have extra terms, the point of the Series Seed is it's kind of a watered down Series A. So you have less documents, which I'm going to get to. And so that's why 10,000, that's the typical amount of back and forth. It should be under 10,000. It should never be above that. But again, it depends on the firm you use. You use some firms where they have lawyers that have fees of $1,000 an hour. It'll be tough to stay under 10,000. The next part is future rights. The future rights is important for the Series Seed because the Series Seed is a watered down version of Series A. So they purposely kept out certain things that are normal in Series A, for example, like AntiDilution. And what this states is that when you have a Series A or a next round that has additional rights that are not present in the Series Seed or in this Series Seed round, you will get those rights. So then you'll amend the rights of the Series Seed so that it matches the rights that the next round gets. So you add an AntiDilution, well then now this Series Seed will be changed. In the next round, you'll change it so the Series Seed holders also get AntiDilution. So that's what this provision means, the future rights. And then key holder matters. This is very important for founders. Especially it can come as a surprise for some, where you've owned your company, you've been working hard, you've been bootstrapping it, you own your shares, and now you have investors. Well, they want you to start vesting. What that essentially means is you could lose all your shares. The traditional is going to be 4 years with a 1-year cliff. Well, if you were to accept that, what that means is if you were to somehow quit in the first year or get terminated, well, then you would lose all your shares. And now everything you've built up prior to this point, you would lose it. And so I see a lot of founders who really balk at this, and when they get angry and they really don't like this. On the other hand, from the investor point of view, I'm putting all this money and you can quit the next day. And now you, however much percent you own, and I've seen this where, founder had 40% of the company, and then they decided, you know what, I'm gonna start doing something else. And now you have this company, well, you had other founders, you have other people that step in to make the company better or to keep the company going, but now you have 40% that now is belonging to someone that is no longer contributing to the company. That's called debt equity in the industry. There's equity that's now kind of mentioned before how you have, when you're doing each new round, investors want a certain percent. Well, it's tough. It's a zero-sum game. Everything always has to add up to 100. And if you have a certain amount that's now going to someone that's no longer contributing, that's an issue. To resolve that issue, you have this vesting. This is negotiable. So you can negotiate it. That's why I see some will do it so that it's, maybe you have a certain amount that's already vested, right? You start off with 50% is already vested, and then the rest is subject to that. And I think I had some question.
Yeah, I did have a question on this because I've run across some documentation, creation of the corporate docs. They already did this. So they are already in some kind of a vesting period. What happens in that case, when a Series A comes in and sees that? Let's say they've still got a year to go.
Okay. In case people online didn't hear, the question is, he's seen documents where they start off vesting. So you start off the company, you form the company, you start vesting immediately, and then maybe it's 2 years later, you're on a 4-year vesting schedule and you've already vested 2 years. What do you do in that point? Very good question, because for my clients, when I start them off, I do that. I put them on a vesting schedule immediately. The reason why is it's a negotiating, essentially a negotiating tactic. You get leverage. You can now point to vesting that's already occurring, and basically you point to the investor and you say, hey, you don't need to change anything, I'm already vesting. So whatever you want to do, you're changing something that's already there. Another way to say this, because I like to keep things real, is to change anything requires getting a lawyer involved, which requires more money. So one way to save money is saying, hey, just leave things the way they are. Why change it? Changing things means you have to hire somebody to do that. So that's a way to negotiate. Now, again, if you had the vesting schedule and now it's already like 4 years later and you're already fully vested, then you're not a good, it's kind of the same thing. They're going to want some vesting. But if it's a year later, year and a half, you already have something, you negotiate it. And I've seen a lot of times, maybe you've had 2 years, so you have 50% already vested, and the investor will be like, well, that's still too much. How about you have 30% vested and the rest goes onto the vesting schedule? It's usually some kind of negotiation with that. So that's usually what it is. It's a negotiating tactic that I like to employ for my clients so that, one, they're not surprised that vesting occurs. And then two, when it comes time to getting the investment, you have a number you can point to negotiate off of. The other point here is single trigger versus double trigger. Again, this is the template document. It says double trigger. What that is, so a single trigger means, it refers to acceleration, which means what happens upon a sale of a company. Because if you're unvested, essentially like you don't fully own the shares. So if you only have 50%, well, if you sell the company, well, hold on a second. I'm supposed to have 100%. I'm just vesting it. So you want it to accelerate so that everything becomes fully vested upon the sale of the company. But then that's a single trigger. Single trigger means sale of the company. That's the trigger to accelerate 100% of your shares. So now you own everything. You get to sell it along with everybody else, and you can move on with your life. Double trigger would mean that two things have to happen for your shares to accelerate. One, a sale of the company, and two, you have to be terminated. And then usually it's terminated within 6 months, terminated within a certain amount of time. So if you're not terminated within 6 months, well, then your shares will continue to vest as normal. And if you are terminated, like in the first 6 months, or you can negotiate that as well, 3 months, 9 months, a year, that can be different amounts, but 6 months is the most common. The reason you have a double trigger is worse for the founder. But the reason an investor will want to have a double trigger is that it usually increases the price upon a sale. Because if another company is going to buy you, a lot of times they're going to be buying not only the assets of the company, but the people. And if you're a key person, they want you as a key person to now come along with the company and to continue working for the company. And so we want you to continue to have your shares vesting, which helps lock you in and stay with the company. So if you have single trigger, well, then now we know that you're no longer have a real reason to stick around. You now got paid out and you can just leave to the buyer of the company on the sale. So they want to buy the company, they know you might leave. Well, that lowers the value of the company because now we can't count on you to stay with the company, or we have to offer you something new on top of that. We have to offer you more money. We have to put you on a salary and add some bonuses. We have to do something, which is an additional cost, which then means it's a lower price for in the sale, lower sale price. So that's why an investor wants double trigger. As a founder, you want single trigger. So that's one thing that it's in the template for double trigger, but you can negotiate that and switch that to single trigger. But again, it's the reason why it's there is because of the sale price on the sale of the company. And then the last provision is about the assigning IP. This is something that should be standard for all companies, all your employees, anyone that's developing anything for the company. They should be signing an IP, is called an assignment of inventions agreement, where they assign all of the inventions that they create for the company to the company. And the founder should have something like that as well. So that everything that all the IP that they're creating, it belongs to the company, so it gives value to the company. Then the last part is the binding terms. And the binding terms, from which all venture capital term sheets, there's always two of them. One is that the terms of the term sheet are confidential, and two, that there's an exclusivity period. The exclusivity is also called a no-shop. So if you hear the word no-shop, it's the same thing as exclusivity, which means that you're not going to shop this around after you've signed it. So, and it's usually for a certain amount of time. Usually it's like 30 days, 6 days. Usually it's enough time to actually draft the documents and close the deal. Because if something happens during the drafting of the documents or the negotiation of the documents that blows up the deal, well, then you want to be able to shop this around. So you don't want this to be too long. And the other important point, I think, on this one is these binding terms come into play once you've signed it. So I've had that question a lot from clients where they're like, well, I guess I can't shop this around because of the binding terms. I was like, we haven't signed it yet. So until you've signed it, you can shop this around. You don't have to keep it confidential because you haven't signed it yet. It's just once you sign it, now you can't tell people, you can't share this term sheet with other people. And you can't talk to other investors. You got to, focus on this deal once you sign it. But prior to signing, it's, you're free to do what you want. Knowing though, I think in the industry, it's a small industry, your reputation matters. You don't want to be misrepresenting anything. And so you act with honor, I'm going to say. But from a legal standpoint, there is no legal requirement until you've signed this. So that's an important point to remember. And that's pretty much the whole term sheet. That's pretty much it. It's pretty simple. It's really like a page long. But I also want to go over what I call it optional sections. These are additional terms that I'm seeing kind of creeping into Series C. And essentially, these are terms that are from Series A. I've done what they call it Series C, but it really, they even do away with the Series C documents. They're just using Series A documents. They just call it a Series C. I see that all the time. A lot of it depends on the amount of money they're investing. You're putting in more money, you want more rights. So a common term is redemption. Redemption basically means that it's usually after a certain time period, and basically it's 6 years. It's the most common time period. I don't think I've ever seen anything other than that. Basically, after 6 years, they get the right to redeem the stock, which means that they have the right to force you to purchase back the stock that they got. And it'll be at that price plus interest. So they invested $1 million, it's $1 million plus interest. And that interest rate, like this is from the NVCA model documents, it's 6%. That percentage can be played with. But basically it'll be $1 million plus 6%. At the end of 6 years, they can force you to buy back. In reality, there's usually a reason why maybe you haven't gotten sold or IPO'd in 6 years. So you won't have the money to pay back a redemption, but it gives them rights, leverage to hold over you. It's like a sword of Damocles. They can I mean, technically, they could force you into bankruptcy if you don't pay them back. Normally, what really happens is they just negotiate some different terms. They negotiate something to appease them because they haven't gotten the money back. And a lot of the reason they have this is, again, a venture capital fund, they have their own requirements and parameters. They have their own deals with their limited partners. And usually those deals are, they have to return the funds back to their limited partners within 7 years, usually 7 to 10 years. So that's why they want to have this redemption by 6 years. But that's, again, this is a Series A term that is getting more and more common in Series Seed. Anti-dilution, I kind of mentioned before. This essentially means that, okay, you do another round, and if it's for a lower price per share than what they purchased, so then they're basically getting diluted. This is a mechanism by which the conversion of their preferred stock to common will then increase so that they have less dilution. And there's 3 basic methods for anti-dilution. There is full ratchet, which has its sounds. It's not good for the founder. It basically means they get no dilution. So again, this is a zero-sum game. You can never have more than 100%. So if one investor has 10% and he does not get diluted, that means everyone else is getting diluted. And they're getting diluted more than they otherwise would have because this investor is not getting diluted. So then you have the other, so that's full ratchet is kind of the worst off for the founders. It's the best for the investors. Rare I see full ratchet. Rarely see that nowadays. I mean, during the Great Recession 10 years ago, I saw it a couple times. What you'll see more often is broad-based weighted. It's called broad-based weighted average anti-dilution. So that is a formula. It's a relatively complicated formula, and if you see in the documents, for me, it's one of those things where it's usually about 4 pages, and it is where I get the chance as an attorney to take a mathematical formula and put it into legalese. So it's 4 pages long, and it's just a formula to come up with a way to then have it so that it's not, they're not fully diluted, but they're not, it's sort of in between. Let's say if they didn't have any protections, their 20% would go down to 15%, and full ratchet, they still have 20%. With broad-based, people end up being usually around, again, this all depends on the terms of the deal. There's a lot of variables here, but just an example, it might be 16.5%. And then the other one is narrow-based anti-dilution protection. And narrow-based, again, it's in the calculation, it's a narrow base, which creates a price per share, a conversion price, which then means that in that previous example, instead of 16.5%, it might be like 17.5% or 18% with narrow-based versus broad-based. So these are different methods. Basically, like, okay, they get some protection from dilution, and that's in a Series A, and normally not in Series C, but I'm seeing that more often. So if you see that in a term sheet, that's what it is. Question?
So question is that it's also called down round, right?
Yes.
So is it not possible where a company will say, you raised $10 million and now the new valuation is $500, so we will basically convert our 10 million will become, our valuation will drop for any future down rounds as well.
So your question is, if
The question is like, imagine, have you seen a provision where investor will say, any future round, it is down, we will get more shares too.
well, that's essentially what this is. That's essentially what this says. It's for any future down round, they get more shares upon a conversion.
Upon whatever, so Series A was a $10 million valuation, Series B at $5 million, so they say, okay, I'm investing at $5 million valuation.
That would be a full ratchet.
That's for Ratchet. Okay.
That's full ratchet. And when it wouldn't be, they would be investing, but their conversion. That's why you have that section where the preferred stock converts to common. So actually on your cap table, nothing really changes, but now they get this anti-dilution right, essentially, where then if they want to, they can convert to common stock at any time. And now they have to convert using this anti-dilution mechanism so that now their conversion will be at a rate that, if it's full ratchet, they keep the exact percent as what they did before. So it's not actual shares being issued, it's just more of a conversion mechanism. It's actually a very elegant way to do it, because if you were to issue more shares, there's potential tax issues, there's a lot of different issues of issuing more shares, but it's a change in the conversion price. And that really kind of protects the investor, because it always works with that conversion will always occur upon like a sale of the company, which is when you really care. Or if you want to, you can convert it anytime you want, and you can always affect that. So
The Prorata is, I still believe that, like imagine you raise $1 million at $10 million valuation, okay? You own 10% of the company. Now the company valuation went down to $5 million. So you should have 20% of the company rather than 10%.
I mean, so what would happen is essentially is the full ratchet where you would still have the same, you would still have the same amount, like those dollars that you invested would convert to that amount.
Yeah. Okay.
But as you guys see, and I guess online, hopefully you heard it, the question was really about what happens if you have 10 million valuation and then you have a next round, it's a 5 million. So what happens to those previous investors, and that's what the AntiDilution is supposed to protect is, okay, now the price per share is half. Well, full ratchet basically means that now your conversion has been cut in half. So now normally your conversion price is the same as your purchase price. So now if it's been cut in half, now you get to convert to, if it's half the price, you kind of get double the shares. So that's kind of how it works with the AntiDilution mechanism. But as you see, it's complicated. There's a lot of questions. The whole point of the Series C was to be simpler, to have less legal fees. So that's why you don't have the AntiDilution in there, because once you add that mechanism in there, well, there's a lot more questions and there's a lot more people want to mess with it. Messing with it means hiring an attorney and having them spend time messing with it. So that increases the price, which is why Series A will be more expensive than a Series C traditionally. But that's the reason why. But investors will want to have their protection. And the more money you're investing, well, then it makes more sense to spend more money to have these protections. The next one is registration rights. This one I'll just go through quickly. This essentially is the right for an investor to force the company to register the shares with the SEC. Essentially, that's an IPO. An IPO is a registration company. And these are different methods of doing it. There's a demand registration right, which is kind of what I just stated. Piggyback is if the company is already doing a registration of other shares, well, then they need to include the investor shares there too. And then the Form S3 and S3 is a simpler form of registration. And then it'll be usually terms in the term sheet of like expenses, who's paying for the expenses of this registration. Can they transfer their rights to, like they can sell their shares to another investor? Well, can they transfer these rights to that investor? Those are the kind of things that'll be in the documents. And then the lockup, and this is pretty common, which basically says for investors, once you have like an IPO, once these things have been registered, they're locked up usually for 6 months where they can't sell it. Because once you have it registered, it's on the public market. And if everybody I've been holding these shares for years and now I get the chance to sell it to anybody, well, if everybody starts floating and tries to sell at the same time, the stock price would just go down. So to prevent that from happening, you have a lockup, which means you have to wait 6 months after the registration to start selling it. And that helps protect the price when you first go out there. Next, here's an additional term. This thing I see sometimes, it's a super prorata. What that means is, so I told you the prorata rights. I invested 10%, I get to invest 10% in the next round. Super prorata means I get to invest more than 10%. Usually it's based on a dollar amount. So if my 10% was for $1 million, maybe the next round I want to be able to invest up to 2 million, up to 3 million. So you have the super prorata which says I can invest up to X number amount. I got this example. This is from a smaller deal, but they were investing 200,000 and they wanted the right in the next round to invest up to 500,000. So that's called a super prorata. And it just means they can invest more. And it's a company, they want to protect their upside because if you're doing well, they want to double down and they want to be able to put in more money. And this is what their ability to do that. And the other thing important to remember, the same issues with the prorata. Again, if they don't exercise it, that raises a question. And also it's whatever they're taking up, that's a percent. It's a number of shares that can't be sold to a new investor. And if your cap table is tight, then it's tough to find a new investor because they'll want to get a certain amount. So something to remember here, documentation. So a Series C preferred financing, it usually consists of 3 documents. It's an amended and restated certificate of incorporation, also called a charter. It's a stock investment agreement, and it's the investor rights agreement. So the stock investment agreement is essentially like a stock purchase agreement and also includes some of the language that you would normally see in Series A and these other agreements. So Series A has a stock purchase agreement, amended and restated certificate of incorporation, investor rights agreement, and then has two others, which is the right of first refusal and co-sale agreement and the voting agreement. So those are one of the reasons why why it's less expensive for the Series C is it's just less documents. So the less documents there are, less there's to review, the lower your costs are going to be. I mean, it's the same kind of thinking as for like the safe note. Safe note is a shorter document, simpler document. Because of that, it's more expense. So that's the important thing. I'll go back. Here's Series C. It's these three documents, and Series A. It's basically kind of those three, and then he has two more in addition to it. That's pretty much it. And here's kind of the term sheet again, on it looks the standard one. And I don't know if anybody has any questions.
Do you ever do term sheets for anything other than Delaware, other states, or does Delaware have like this monopoly?
I know well, it's close to monopoly. I would say maybe like 98% of the time it's Delaware. The next most common would be Nevada. Nevada would be the next most common. Coming up now, there's some like Wyoming. They're becoming much more popular now. I've seen them more like in the cryptocurrency space. They're becoming more popular. Nevada's also popular with crypto as well. The vast majority are Delaware. But outside of that, I've only seen Nevada and Wyoming outside of Delaware.
I mean, Wyoming's popular because it's cheap. Is that the same with Delaware? I mean, our costs have gone up here in Nevada, so not as desirable as it used to be. But
that's exactly right. I think that's been part of the reason people have been going to Wyoming. The people who would have gone to Nevada, a lot of them going to Wyoming. Wyoming also has the right to have a lifetime proxy. So what that means is you can have a shareholder, and that shareholder gives a proxy to. So I can have you as the shareholder of LLC that I form, and then you give me a proxy, which basically means I get to vote all your shares, which means I get to control the LLC. But on the books, you're the only owner. No one knows that I exist. That's why people like Wyoming. So, yeah, unless they beat it out of you, which is, you might not like Wyoming. But yeah, that's but the vast majority Delaware. I mean, every so often you'll see people that they're registering their home state. The issue is that legally there have been challenges to a lot of these provisions in Delaware, and they've been in Delaware mostly. So Delaware has a case law. So, for example, like I'm in Texas. Texas is a big state, and if I'm looking at a Texas corporation and I'm looking at some issue like some minority shareholder rights issue, like there's some minority shareholder that's really having complaints. They're like, hey, I don't want this financing deal to happen at all. They didn't notify me. They didn't do all these things. I can look up in case law in Texas, and I'll tell you half the time there's just nothing out. I've never seen anything on there. I look up Delaware case law, and there's been a lawsuit about this before. So what that gives you is just much more certainty. And so as an attorney, I can tell my client, hey, this is how Delaware handles it. I can't do that for a lot of states. So that's why then people tend to go to Delaware. I mean, investors essentially will definitely prefer that, because especially if I have a portfolio of 20 companies, I want to make sure that, okay, they're all kind of the same. Also, if I have an issue with one company, I hire an attorney to give me a legal opinion. Now I know that a legal opinion applies to my whole portfolio, as opposed to if I have companies in different states, now I have to get a different opinion because it could be different in different states. And so that's part of the reason for the dominance, really. It's part of it.
they also make it super easy to incorporate it.
Yeah, I'll tell you, I recently have an issue with California. For me, California does not want, I mean, that's the thing, the advantage for Nevada, you can get a lot. California does not want your business. I mean, it is clear. We were amending a certificate of incorporation. They had 20 million shares and they wanted to change it to 16 million voting and 4 million non-voting. So then we did an amendment and restatement, and we just stated that. But we didn't say 20 million total divided into 16 and 4. We just said 16 and 4. And they rejected it, saying, no, you have to say 20 million divided into this. But the thing is, they actually have an example online. The example, I just did exactly his example. They still rejected it. It's $800 filing fee. It's like $90 in Delaware. $800 in California. When you reject it, I have to pay $800 again to file it again. Well, I filed it again. The company had one owner. He was the president and secretary. They rejected it a second time for something that was in the original, but they didn't say anything about it. But they rejected it a second time saying, he's the president and the secretary, he needs to sign 2 times. And it was just like, what are they doing? And it took like a week and a half to get the rejection. Delaware usually very quick. So for me, it's like some states like California, it's like, for me, it's clear. They don't want the business. I mean, they use this amendment as a way to just generate cash as opposed to, just help. I mean, it's just a formality in one sense. So in different states act differently.
Since you set up Delaware corporations, are you licensed in Delaware?
No. That's so essentially every corporate lawyer in tech in America, I mean, they deal with the difference. They say is to be licensed in Delaware. That would be to be going to court in Delaware. Something like filing is something that's not considered a practice of law. So, for example, like LegalZoom can do it without being lawyers. All these different services, they're doing these filings without being lawyers. So that's kind of issue. That's why it's not considered. That's why you don't have to be licensed to do filings. And if you did, every corporate lawyer in the U.S. would have.
New income for Delaware.
Well, that's the thing. So the Delaware, their mindset is let's make things easier.
Yeah.
So, for example, Florida, their attitude is more like kind of what you're saying. So Florida, it is more dangerous to file something on someone else's behalf because Florida takes a very active. They don't want any non-Florida lawyers doing anything with Florida. They actually they had to come out with new guidance because previously, if I'm a lawyer and I go to Florida on vacation, and while on vacation I do legal work for a client, even if it's a client in my home state, that would be considered the practice of law in Florida, and then they actually would go after people for that. Because of COVID, they relaxed. They relaxed. So they actually have some recent opinions where they kind of said, okay, you're allowed to do that, but you can't talk to anybody in Florida. But that is kind of an issue that sometimes comes up. But when it comes to a Delaware law, it's not really an issue. Frankly, Nevada, traditionally has been kind of easy to do business with, but I guess as we all know, it's been changing recently. But,
Well, there was a point at which we were trying to automate the formation of companies. So there was a requirement to use an API to form a company rather than going through Silver here in the state, going out the forms on the website. So just essentially automating that process. Delaware has that. I mean, you can form a company in Delaware in about 10 minutes.
Well, Stripe used to have Delaware.
Right. In Nevada, I actually talked to the people at our Secretary of State's office about this project, right?
Yeah.
Trying to do it. They couldn't figure out how. It was like, well, if we do that for you, we're gonna have to do that for everybody. It's like, that's a problem. Why?
One thing to say with Delaware though, you can get it within minutes, but they do charge more. It's $1,000 fee if you want to do it within minutes. The normal fee is like 90. They do.
Yeah, but if you go through their API.
But actually right now in Delaware, they're having issues because of COVID, because right now, because I do incorporations like almost like every day. It's been taking 3 to 4 weeks. If it's not expedited, if I don't pay, you just pay the $90 fee, normally it would be 2 to 3 business days. Lately, it's been 2 to 3 weeks to a month. So there's been a lot of different, changes because of COVID. But,
Well, my case at the Secretary of State's office in Nevada was, you'll get more fees. If you just open this up to everybody, you'll get more fees. You'll compete with Delaware. They just didn't know what to do. Couldn't figure out.
That's right. No, that's right. I remember. I remember when I started my legal career, and I was like in DC, and we would always hear like it was Delaware versus Nevada.
Yeah.
And Nevada was more a higher percentage. I think it said before it was like 2% now. It used to be a higher percentage. It was more like 10, 20%.
Yeah, our fees are slightly higher, but if you made it easy, I don't know if the extra couple of $100 would make that much of a difference. But I'd be willing to do some electronics.
That's right. That's right.
Okay.
So, any other questions? Do you have any questions online?
No.
Nice. Well, hopefully that means that I was thorough and easy to explain. So, if you do have any questions, you can reach out to me, Jose@Padilla.law. My law firm website is www.padilla.law. Happy to talk to you anytime, and thank you.
Thank you, Jose. That was great. It is a rather dry sentence. Because I know you're a funny guy. You're like, "Ugh."
I try. And then I just noticed there's more jokes at the beginning than the end, because then it's like I start thinking, like, oh, no, I just want to get through it.
So join us next month. It's November 9th. It's always the second Wednesday of the month. Next month, we will have John James, and he will talk to us about LinkedIn video marketing. So thank you all for coming.